Hello everyone, let us continue with our discussion. So, in the previous topic, we have understood forecasting the capital market expectation. Clear? Now, in this lecture or in this particular reading, we are taking this step ahead. Okay. Now, we are going to understand the tools for forecasting the returns. Now, returns for different asset class. It can be your bonds, it can be your real estates, it can be your equity. We will be forecasting the volatility, currencies, so many things. Clear? So now my focus was to understand the forecasting, the problems with respect to forecasting, economic growth trend, all these things, business cycle, different aspect of the economics. Now we are actually inside the core understanding of, sir, let's start the forecasting. Okay, forecasting for the real estate, forecasting for the equities. Clear? Now over here we are going to cover 8 different points. Number one is we are going to forecast fixed income returns. Fixed income returns. That means your bonds. Second, we are going to understand the emerging market bond risk. Why I am specifically studying about the emerging? Because the behavior of the bonds in developed economy versus developing economy is huge. Clear? So I am going to specifically cover the emerging market bond risk. Then I will forecast the equity returns, another asset class. Okay. Then we are going to understand the risk premium approach. Again, a part of it. Risk premium approach. Higher the risk, higher the return. Clear? Then we are going to forecast the real estate returns. Real estate returns. Clear? Then we are going to forecast the exchange rate, currency, exchange rate, currency. Okay, we are going to forecast the volatility. Clear? And finally, when you are investing in the global portfolio, then you need to make few of the adjustments that we are going to study, and everything is going to be covered in minute detailing. Clear? Now, let us continue with our discussion. See, when I am saying that I have to do the forecasting, clear? Now, does it only means that I have to forecast the future returns, which I was talking in the previous session? No. Yes, we have to calculate or understand the future returns, but along with that, we need to consider the risk. Also, we need to consider the market behavior. Clear? All the 3 points we need to take care. Return, risk, also the correlation between the assets and market behavior. Okay, you will have these notes uploaded on our portal, so you can just download it, and whatever you feel like you can write it along with the session. So take the printout, it will be much easier for you, time saving. Clear? Now, why we do forecast the returns? Clear? That we need to understand. So before investing, what we always try to predict that how much return we will earn, that is your expected return, how much risk is there, variance, volatility in the investment, and how different assets will move together, that is correlation. These information I need to have before I go for my investment. Clear? Also remember key points like time matters, like investment opportunities changes with time, just like the change in the price of the vegetables, they keep on changing every day, every week. Clear? Similarly, the opportunity, the return, the risk of the assets keeps on changing. Clear? So most investments tend to go back to their normal or fair value over time. What does this mean? This means that if this is the normal value of a particular asset, and if currently asset is trading at a higher price, so you will see that its value tend to decrease. Similarly, if one particular asset is below the normal price, it tends to increase. Clear? So we have to go back to our normal or the fair value, and we call this as central tendency. Clear? We call this as central tendency. Like if gold price suddenly shoots up too much, then after some time it come back to closer to its the usual level, or what should be its the real level at that point of time based on the demand and supply. Clear? Now there are three ways to forecast the market expectation. One is your normal formal tools. Clear? Statistical or model based tools. Second, we can do the surveys, and third is the judgment. Clear? 3 points. Statistical, formal tools. This includes your all your scientific and mathematical tools. Then we have surveys and judgments. Clear? Now when I'm using the statistical method, clear, this can include your simple statistics like calculating the mean, variance, correlation, okay, with the help of the past historical data to predict the future. Clear? Like if your monthly expenses for the past 12 months were around 20 to 25,000, then you will assume that your next month also will fall in the same range, and by this method you can keep the money with your considering that yes, this is my monthly spending range 20 to 25. Okay. Shrinkage estimation. What is this? Shrinkage means weighted average. Shrinkage means weighted average of the historical estimate and adjusted projection estimate. Like suppose if your past exam score was 60, 62 and 58 like this. Clear? But this time you have studied hard. Definitely you will predict 70. So you have taken into consideration the past score 60, 62 and 58. But now you have adjusted it based on the recent scenario. The scenario is you have studied hard. So you don't completely trust your past score. You combine it with the past score plus your new expectations. Are you clear? Shrinkage, weighted average. How much weight I should give to my historical data? How much weight I should give it to the new information which is available in the market, and based on that I will design and prepare the plan. Clear? Third one is time series estimation. Time series estimation. See, basically here we forecast using the past pattern and the trend of the same variable. Okay, you can write it down as well. Okay, we have mentioned it. Use lagged value means the past values of the same variable and some other related value as well. Clear? So basically over here we are going to check that how the variable behaved in the last month, how it behaved before that, and use that pattern to predict it the next month. Like I'll give you one example. In 2023 during the rainy season, what was my sales of my raincoat? Okay, in 2024 rainy season, what was my sale of raincoat? Similarly, now how much to produce in 2025? I will use these two data, continue the pattern, and accordingly I will produce in 2025. Are you getting my point? So basically we can predict the tomorrow's temperature when we look at the today's temperature, yesterday's temperature, weather trend, humidity and wind speed. So this is a time series forecasting based on the timing factor. You see timing today, tomorrow, yesterday. So using the time trend, you are forecasting the future. Are you clear? So in the statistical, we have studied 3 points: sample statistics, shrinkage estimation and time series estimation. Clear? Coming to the next point is your discounted cash flow model. Okay, we have studied it before in our level 2. Like value of the investment is the present value of the future cash flow. Value of the investment is equals to the present value of the future cash flow. Clear? So this method actually focuses on the future earning, not the past data. Like if I'll offer you two jobs, one is going to give you 40,000 rupees per month today, and another job will give you 45,000 but starting after 1 year. In one job you are getting 40,000 per month every year, but in another job I am saying you will get 45,000 but from the next year. So what you will do, you will discount the future money and see which one is better now. Suppose 40,000 today, but suppose when I've discounted this 45,000 and today it came out to be 42,000. Now which one is better, 40,000 today or 42,000 today? Definitely 42,000 today. Clear? Similarly, analysts will discount the future profit to calculate the fair value of the stocks and bonds. Are you clear? Our next model is going to be risk premium model. Risk premium model means what? Expected return is equals to your risk-free rate plus premium for the priced risk. Basically, if I am taking some extra risk, I need the premium for that. Clear? So what is risk premium? Extra reward for taking additional risk. Clear? So this will include your CAPM, factor models and build up models. Okay, building block model also known as build up models. Clear? Like if a bank FD will give you 6% and stocks is giving you 12%. Now this 6% extra which you are getting in the stock market, we call this as a risk premium. Clear? Similarly, we have two other ways of finding out the information. Finding about the future is survey, or you can trust the judgment, expert experience. So when I'm saying the survey, so over here analyst will ask the experts, economist, fund manager, analyst for their opinion about the GDP growth, clear, about the inflation, about the market returns, interest rates. So I will try to identify these information through expert. Clear? So this gives me a consensus forecast, means what is the common agreed opinion. So like when you ask 10 teachers how difficult the exam is, so if most of them will say it's easy, you will get a general picture that exam which is going to come tomorrow is going to be easy. Clear? Similarly, the another point is judgment. Judgment basically when we use the mathematical model, and sometimes we need human experience to adjust the forecast, because model can fail during the unusual times like COVID, financial crisis, war, sudden government policy changes. Clear? Over here we combine those models with the gut feelings plus the experience. Clear? This is just opinion, but this judgment is opinion plus models combined together. Are you clear? Like Google Map says that you will reach office in 30 minutes, but you know that there is a political rally today, so we'll add 15 minutes extra. We call this as a judgment. Clear? These are not available with the models. Clear? So now I have just given you a brief understanding of different subset of the models. Now moving ahead with our topic, that is I need to do the forecasting of the fixed income returns. Clear? So now I have three things to be discussed: discounted cash flow method, risk premium approach and equilibrium model. The same thing you will find it in the equity forecasting as well. Discounted cash flow, risk premiums and equilibrium model. Clear? So let us start the discussion of the DCF. Okay. See, DCF means what? Discounted cash flow. Clear? What is this discounted cash flow? Finding today's value of future money. Finding today's value of future money, or you can say the present value of the future money. So this method actually helps us to estimate what return we will earn from the bond. Clear? Like when I am saying a bond, we know that the bond have the future cash flow. It can be in terms of the coupons, or it can be in terms of the maturity amount. Clear? It can be anything. It can be your coupons or it can be your maturity amount. Clear? Now we know that cash flow can be estimated correctly because the bonds will give the cash flow at the fixed date. So DCF is very useful. I know that I am going to get these coupons in the given time frame, and at maturity I am going to get my principal amount. So I can calculate the present value of future cash flow very easily. Clear? Over here, one more term is introduced, YTM, that is yield to maturity. So the present value of all the future cash flow is equals to the bond's current market price. You can write it down. What is YTM? In simple terms, present value of all future cash flow, present value of all future cash flow is equals to the bond's current market price. Clear? Now, if you put all the future coupons and final amount into a calculator, YTM is basically the return that makes the total amount equals to its today's price. Means it is saying that you are getting say $10, $10 and 110. Suppose the YTM which I know is say 10%. The YTM which I know is 10%, and this 10% actually says that after discounting the present value of the bond is 100. So what is my YTM? 10%. So the present value of all the future cash flow when it is discounted at the given rate and it leads to the current market price, then that rate is known as the YTM, or YTM is also known as the IRR, internal rate of return of that particular bond. Clear? So you will earn this YTM. You will earn this YTM only if you will hold the bond till maturity, and all your coupons will be reinvested at the same YTM rate as soon as you will get it. Like if the bond is giving you 5,000 every year and YTM is 7%, then you will reinvest those 5,000 rupees at the 7% again. Clear? You keep on reinvesting your coupon, and at maturity, whatever you will get, that is your final amount. So if you reinvest at a lower rate, your actual return will drop. Clear? Now over here, they have introduced one more term, that is zero coupon bond. Zero coupon bond means it will not give you any coupon. There are only two values, present value and future value. The one which you are going to pay today, and the future value is the amount which you are going to receive at the maturity. So there is no reinvestment risk because there are no coupons, but still you will get the YTM only if you hold the bond till maturity. Clear? Now, what if, sir, I don't have a single bond, I have a portfolio of the bonds. I have a portfolio of the bonds. Clear? Now in that situation, what is the YTM of the portfolio? YTM of the portfolio. This YTM of the portfolio is equals to the weighted average of individual YTM. Weighted average of individual YTM. Suppose you have 5 bonds. One is giving you the YTM of 6%, another is 7%, another is 5%, another is 2%, another one is 11%. Different YTMs. Everyone have their own weight in your portfolio. So you will multiply them and you will add them. Clear? So this is generally a very good approximation of the portfolio's expected return. Mark my word. This is generally a very good approximation, not the exact portfolio's expected return. This is an approximation. Clear? But actual return may differ from the YTM, because if all expected cash flows are received, then the actual return may not be equal to the YTM. There are three reasons. Means you hold the bond till maturity, still there is a possibility that you will not earn the YTM, and there are few reasons for that. What are those reasons? Why your realized return is not equals to the YTM. First one is investor sells before the maturity. If he will not hold the bond till maturity, you will not get the YTM. Price may be higher, capital gain. Price may be lower, capital loss. So this will change your return. Clear? Second reason is interest rate keeps on changing. That will affect your reinvestment. Clear? Suppose interest rate will increase. So what will happen? You will reinvest your coupons at a higher rate, more profit. If interest rate started falling, then you will reinvest at a lower rate, loss. Clear? So this totally depends upon your investment horizon as well as the maculae duration. Okay, you have studied all this before, so I am not entering again into your investment horizon and maculae duration. Clear? Now there can be third reason. Third reason is your options. Call option embedded bonds or put option embedded bonds. So that will also change your cash flows, because you know that if the interest rate will decrease, company will call the bond. If interest rate will increase, you will use your put option right. Clear? Now just for the sake of your revision, that how this horizon and maculae duration is going to impact your returns, I have just mentioned it over here. You can just give a thorough reading to it. Clear? So now why these things are happening means, you have a bond. Okay, the bond have a period of say 10 years. Clear? You have a maculae duration at this point. Clear? Now if the interest rate will decrease, if the interest rate is decrease, clear, that means what? You are reinvesting your coupons at a lower rate. Clear? But there is a possibility that, sir, the increase in the price of the bond is higher now. Now the value of my bond is higher. So if today I will sell the bond, I'll get more return. There is one possibility. Again, interest rate is still falling. Interest rate is still falling, but the duration for which you are going to discount your bond is lesser. So that means what? Price fall gain is less, but the loss on reinvestment of the coupon is higher. So your return is going to be lesser. So like this over here, you can see that price effect dominates. Clear? So if the rates are falling, the price effect will increase. That means you will gain in the bond. Hence the reinvestment portion is looking very small. So rise in price is that much. Fall in the reinvestment is this much. Still you are at gain. Clear? Higher returns. And if the rates will start rising, then what will happen? The value of the bonds will fall very high, but reinvestment profit is just this much. So still you are going to have a loss. Clear? And how to calculate the maculae duration when you have the modified duration is modified duration, multiply it with 1 plus YTM. Clear? Now another approach of forecasting the return on your bonds is the risk premium approach. Clear? It includes 4 factors. One is your short term risk free rate. Then the term premium, how long is the term? Credit premium, if there is any default risk or not, and whether the bond is liquid or not. Clear? So now if your risk free rate is high, definitely the return of the bond is high. Term premium is high, means the larger the maturity of the bond, the higher the interest rate. Credit premium, if there is a default risk, the return of the bond is high, otherwise it's less. Clear? Liquidity, if the liquidity risk is high, the interest rate is high, otherwise it's going to be lesser. So now we will look at all the 4 components one by one. The first component is your short term default risk free rate, or you can say risk free rate. Clear? So basically there is a zero chance that borrower will fail to pay the money. And who can give such type of guarantee? Government of a stable country. Mark my word, if I'm saying it like some country with a very poor economy, Zimbabwe, Kenya, Pakistan, Bangladesh, it become very difficult. They cannot give such guarantee. Sri Lanka. Clear? So who can give such guarantee that my bond is risk free? Government of a stable country. And why I am saying it for a short term? Because in the long run anyone can default. Clear? But interest rate on a short term government security where the risk of non payment is basically zero. Like India, the treasury bills, T bills, risk free. In the US, treasury bills issued by the US government. So these are considered to be the safest. Clear? And short term, because we know that in a short run, in the coming 3 months, see, nothing will happen to India. But if you look at the 30 years, anything can happen to India, Japan, China, US. Okay. So no one can guarantee for the next 30, 50 or 100 years. Clear? So short term is the safest one. Clear? Now, if you are forecasting the return for 3 months, then what you will do? You will use a 3-month default rate. If you are forecasting the return for 6 months, you will use the 6-month default free rate. Clear? Because the time period of the rate should match the time period of your forecast. It's not like that you are forecasting it for the 6 month. You will take the rate of 3 months and then multiply it with 2. No, take the rates of directly for the 6 month. Clear? And these rates are calculated from the most liquid asset. Liquid means you can easily buy or sell something without their price being getting affected. Why? Because they are heavily traded, and that's why there is extreme liquidity. Clear? So they will give us the true and accurate short-term risk-free rate. Clear? Now there is one more point, that these short-term interest rates, okay, they are tied to the central bank policy rate. Means when RBI or US Fed increase or decrease the policy rate, then these short-term default risk-free rates also goes ups and down. Clear? Like if RBI will raise the interest rate, so what will happen? The treasury bill yield will also increase. Or if Fed will cut the interest rate, T bill yields will also fall. So this connection is very strong. Clear? Now sometimes we need to normalize the rate. Normalize means we need to adjust the rate to remove any temporary distortion or some unusual condition, like during the financial crisis. Okay, rate may become artificially low, or during the inflation, short-term interest rate will become unusually high. So in that situation, we need to adjust the rate so that they will reflect the normal economic conditions. Clear? But sir, suppose I am not my bond which I am using, okay, it's not for say 3 months, 6 months, or 9 months, or 12 months. My bond is a for the long term horizon, say 5 years, 10 years, or 30 years down the line. Clear? So but the short term rates are 3 months treasury bills. Clear? So what we'll use, using that short term rates is not ideal. Clear? Then we have two different alternatives. You can see one which we can use is a long maturity zero coupon bond. Like government also issue 10-year government bond with zero coupon rate. Clear? So because it matches with the 10-year horizon. Clear? So that particular bond will give me the better long-term risk-free estimate of my country. Clear? Or second option is rolling over the short-term rates. Okay, like reinvest again and again after each maturity. So what you will do, suppose you want a 3-year rate, but you have the short-term rates of 3 months. After 3 months, you keep on rolling for another 3 months. Keep on rolling. Buy one 3-month bond, sell it after 3 months, buy again a 3-month bond, then keep on selling. Clear? So this create a chain of 3-month investment for the 3 years. So your picturization, it is for the next 10 years. Are you clear? Now, apart from this, you can also use the future contracts, your FRAs, future contracts agreement. Okay, so they can also help you to predict the future short-term rates. Clear? Because they are also based on the market expectation of where the short-term interest rate will go. So this can help us to construct the expected path of the short-term rates very easily. Okay, so what I'll do now, because we are about to approach 30 minutes, so I'll keep this much, otherwise it's very hard to study for long time. So 30 minutes, again I'll come back and we'll start with the second point, that is your term premium. I'm ending this here. Thank you.